We've started at the big picture, high level, big institutional capital flows, what's going on in the markets. And now we're going to dive deeper into what we've called non-traditional capital sources. This is also where we changed up the format a little bit. I've already introduced you to Jim Freed. He's going to moderate this panel. He's promised he's going to stay on the clock. What we're going to do is Jim's going to moderate this panel, and then if you look in your programs, right after we're done with this panel, we are going right to breakout rooms. They're in your program where we're going, and they're labeled outside. And in each panelist, we'll dive deeper into each of these capital sources. The markets are changing pretty rapidly, and this is kind of what we talk about next generation capital sources. So with that, Jim Freed.
All right, I want to thank Paul for those kind words earlier, and I've got another hour-and-a-half slide presentation on South Florida whenever you're ready. Steve, hit it. I know most of you never really listened to my radio show, so I thought I would bring it to you today. All right, Steve, that's enough. That's given everybody a taste. Wake up. This is the future of real estate is what we're going to talk about. It's really today non-traditional investment methods. A lot of people here work for the big life companies, the big real estate companies, big institutional investors. We're going to talk about some things that maybe you don't hear a lot about, but that really are driving the industry as we move forward today. I want to introduce our panel. First, we've got Kendall Almerico. Did I get that right? I always mess up the names. Kendall's a Gator. Kendall's a Gator. He was here when I was here. Kendall is one of the top crowdfunding experts in the country. He was, I believe it was the 15th most influential crowdfunding person in the country this year.
17th, so I'm not quite as good as Jim.
I always give great promotion. Now, this really isn't a promotion. On the end is Tom Thayer, Tom Handler. I get it always. Thank you, Tom. Yeah, Tom went to Illinois, so he's got the right color thing going. And Tom is one of the top estate and trust lawyers in America, actually in the world. He was recently named the International Wealth Planning Lawyer of the Year. 32,000 people voted on that. He won that award last night. Tom operates out of Chicago. We met each other at a couple of wealth planning events. Tom is probably the preeminent wealth manager for some of the family offices. And if you don't know what that is now, you're going to know in about an hour. Then we've got Nathan Rachels. Nathan works with Inland. Nathan he's a wholesaler, I guess is what they would call you, the wholesale guy, Nathan? Because I'm the retail guy. Nathan is the guy, he generates the product at Inland, and then I can sell that with my 22 and my 63. Are those the right numbers? Correct. All right, well, Rob is nodding because Rob, he's the senior guy from Silver Portal. Rob Lee, is there an E in there? Okay, there's an E in there. Is there a Robert E. Lee? Is there a thing going on there?
I'm from Kentucky.
He's from Kentucky.
What they do when you're from Kentucky.
Yeah, that's what they do when they're from Kentucky. Yeah, I think there's something else that goes on. Rob works at Silver Portal. Silver Portal is the broker-dealer that I work with. So you hear broker-dealer, wholesaler, crowdfunding, family office, topics we've never talked about at these conferences before. So what I'm going to do is I'm going to start with Rob. We're going to go down. Each person will talk about what their firm does, what role they play, and then we'll kind of bounce around after that. I never bounce around. Go for it.
Okay, make sure everybody can hear me. Okay, there we go. We actually have 5 different businesses. We're a very small shop based out of San Diego, California, in Del Mar. There's a half a dozen of us, and then we have about 30 guys out there like Jim, who is basically across the U.S. and they're licensed on our platform. We're a FINRA licensed broker-dealer. We're also a registered investment advisor. Been in business under the Silver Portal name since 2001, raised about $5 billion of capital. That's pure equity, not debt. $17 billion if you count our 3 senior partners. I'm actually a junior partner, not quite senior yet, but I'm getting there fast.
I give promotions. Yeah. That's what I do.
Okay, no worries. So we mainly raise institutional capital for owners and operators, developers, typically raising programmatic JV partnerships, 50 to 300 million at a time, for specific strategies all over the U.S. That's our main business. I'm director of that business, and then we do a lot of REIT and real estate operating company advisory. So if a REIT's going to spin out, like Behringer Harvard spun out Monogram this year, we did the advisory on that. On the NYSE listing, we'll do advisory on internalizations of the board, things like that. Public to private transactions, working on a couple of those now. That's mainly what John Haar, our senior founder, does. And JL, they all have Wall Street backgrounds. I'm the only non-Wall Street guy in the crowd. I'm a pure real estate guy. Came from an investment brokerage background and a little bit of development of my own. And then, I'm losing track here. The other business is 1031 exchanges. We do most of that actually through Inland. Actually, all of that right now through Inland. So if a guy sells a property and he wants to get cash into a passive way, they go typically through our platform and invest into a DST, which I'm sure you'll hear more about. It's kind of like the new and improved TIC business. I hate the comparison of TICs. It's way better than the TIC world, but I'll let Nathan tell you all about that. And then we just launched a crowdfunding platform. I launched it in September, officially live this week. That's silverportaldirect.com. We'll be the only, to my awareness, and Kendall, you'll tell me if I'm wrong, we'll be the only guys in the business that are actually a broker-dealer and an RIA, vertically integrated as a crowdfunding platform. We're not going to raise money for the one-off buildings on the corner, but we will just allow people to invest in a sidecar format for these larger institutional raises we do. So if I'm raising $200 million for a retail operator like we are right now in Birmingham, Alabama, the institutional pension funds will be the main LP capital, but the individual investor will be able to sidecar that with a small piece of GP co-invest. And then our last business is our own little principal co-investment fund, which will invest with operators and developers on a GP co-invest format.
Nathan.
Thank you. So my company, Inland Real Estate, was started in 1967 by four former school teachers. And believe it or not, today they're all actually still friends. Not heard of too many people still being in business that long, much along being friends. And they still compete to see who gets there the earliest. Joe seems to win at about 5 o'clock every morning, and he's head of our acquisitions team. But we've grown to be one of the top 10 largest commercial real estate owners and managers in the United States. We currently manage about $24 billion of real estate, both through real estate limited partnerships or REITs, as well as 1031 exchanges, and then we also do stuff on the institutional and pension side. And so really I'm here to talk about the Delaware Statutory Trust, which we actually helped the IRS write. To Robert's point, TICs were just very constraining to investors. And so we actually, in 2004, helped the IRS write the DST, or the Delaware Statutory Trust, and have been doing those since. We started doing 1031s back in 1986 with the Tax Reform Act, and then institutionalized or securitized it back in 2001, and been doing that ever since. Very proud of our track record, because one of the things that is unique to us is that we've never had a capital call. And that's unique. If you've ever owned a piece of property, having a capital call is probably the second worst thing that you can have, other than a bankruptcy, because you're having to go back and say, if we don't do this, next comes the worst. And basically at the end of the day, it allows you to go from an investor that is active to taking a non-active role in it, yet still being able to defer the taxes, keep institutional quality real estate, keep quality of life. And I just had a meeting this morning where the gentleman said, that's exactly what I'm looking for. I'm tired of dealing with the 3 T's, the toilets, tenants, and trash, and I want to actually enjoy some of the fruits of my labor that I've done over these years. He's got about $25 million of real estate, and he's looking to unwind it, yet defer taxes and actually enjoy the income. So we'll talk about that later, but one of the really, really neat things that if you remember nothing else from what I said, and by the way, Jim, I noticed you didn't mention where I went to school, and that's a good thing.
Bama!
The fact of the matter is that we can take your debt from being recourse to non-recourse. So not only is it a way for you to divest of some of your real estate management activities, but to be able to take your debt or for your clients or yourself from recourse to non-recourse on your balance sheet is a huge opportunity. And that was one of the neat things that the DST did versus the tenancy in common. So we'll talk more about that as we go along.
Kendall, you're up.
As Jim mentioned, I was named by VentureBeat as the 17th most influential person in the crowdfunding industry last year, which immediately made me wonder, are there 18 people in the crowdfunding industry? I had no idea. I'm looking at this list that comes out, and all of a sudden people are calling me and asking me questions, and I see this list, and I'm ranked among the people that started Kickstarter, the people who wrote the Jobs Act. No kidding. Mary Jo White, the chairperson of the SEC, was ranked below me on the list. The person who's going to regulate this whole thing. It was ridiculous. Since that happened, Forbes called me the top crowdfunding attorney in the country. And now I have a horrible life because you can see I'm the only person not wearing a tie in the picture. I was in Aruba introducing the country to crowdfunding on Tuesday. Wednesday, I introduced Curacao to crowdfunding. My life is terrible. But I get to come here now to Orlando, where I grew up, in Tampa, right around the corner. And how I got involved in crowdfunding is that up until about, 2007, 20 years of my law practice, I helped people start small businesses. People would come to me with an idea. Some of them grew into large businesses, some of them didn't. But everyone to a T needed money, just like today. How do I get that first tranche of money to start my business? And I would do what every good business attorney did at that time. I'd call up my buddies at Bank of America or SunTrust or Wells Fargo. I knew everybody somewhere. I'd pick up the phone. I'd say, hey, there's a guy here with a great business plan. I know this guy. I like the business plan. I'm going to help him. I'm going to do the legal work. I'm going to be the guy behind the scenes to make this work. He needs $100,000. He's coming over to your office. They would write him a check, give him a line of credit. The business would get started. 2007, 2008, that all ended. I think I single-handedly probably caused that crash because of they were writing checks to almost anyone. But the fact is, since 2008 occurred, I have been looking for someone to fill or something to fill that startup tranche. Where do people get that first $100,000, $200,000 to start a business? This is going to get to real estate in a second. I heard about something through my partner, Tess, who brought this to my attention. She threw an article on the table in front of me in my office and showed me something called the Pebble Watch. This little plastic piece of work was on a website called Kickstarter. And it syncs with your iPhone and it syncs with your Android device and it does all kinds of cool things. And these people had a prototype of this watch. They didn't actually have made it. They had a prototype. They didn't manufacture it yet. They didn't have any distribution. They needed to raise $100,000 so they could manufacture the watch. They went on this website called Kickstarter and went out to the crowd. Not to rich people, not to institutional investors, not to accredited investors. They went out to normal people and said, if you send me $150 rather, in 6 months I'll send you one of these watches when we make it. The concept of giving money to people for something that doesn't exist yet and having people give you that money to me was insane. But they raised $10 million from the crowd and became a very, very successful business. In fact, they're doing another crowdfunding raise right now. They're now available in Best Buy and in stores all over the place. It's a very successful business. That got my attention. But my attention was they got this money without giving away any equity in their company. They just did it by pre-selling something to people that didn't exist. And I said to my partner, Tess, at the time, I said, if this ever becomes something where you can actually sell equity online, if the Pebble Watch people could have said, we want to raise $1 million by selling 10% of our company to the crowd, that's when I want to get involved. And then in 2012, a law was passed called the Jobs Act. And the Jobs Act is going to allow that very thing to happen. And the Jobs Act is what allows now real estate crowdfunding platforms to exist under a different part of that act that we'll talk about later. That's how I got involved in this. I've been writing about it. I consult with it. FundHub, our business, actually does the compliance behind crowdfunding sites. So all the things the SEC requires you to do to stay in line, we've automated it and made it affordable for people to use. And we'll get into some of the particulars about that later.
Tom?
Thank you, Jim. Good afternoon. And first, I'd like to thank everyone for proudly displaying the Fighting Illini colors. That's very considerate of you. And just like you, I very proudly wear the orange and blue. Our firm is a nationwide and global financial boutique. All of our lawyers are accountants, MBAs, CFPs, CFAs, or quants. Our practice is focused on affluent families, family offices, and private companies. So we're kind of at the opposite end of the crowdfunding. We work very hard to stay as far away from the crowd as humanly possible. So the client base is really comprised of families that are large enough to set up an enterprise to run their own affairs, privately held businesses that may be very large, even larger than public companies in many cases, and then affluent individuals, which would include, C-suite executives, professional athletes, celebrities, and anybody else out there. So we try to focus on the high end of the market. My experience with real estate, personally, I've invested or owned almost everything. towers, casinos, farms, industrial, commercial, the whole shot. So I've seen it. I started out in public accounting as a partnership tax specialist. When I came out, syndications were rocking and rolling, and that was really in demand. So my initial accounting career spent an awful lot of time doing partnership work and syndications for real estate funds, and also as a lawyer, that was a big part of our business. Nothing like a 300-page securities offering with a 60-page tax opinion. So that was great work, and then family limited partnerships and family holding companies became the cornerstone of high-end estate planning, so I went from being a primarily tax attorney to primarily estate attorney. As I sit here today, our firm has several advanced planners, and advanced planning means someone that is either primary tax or secondary tax with a strong background in estate, multi-entity business planning, asset protection planning, and so we try to meld those together for the benefit of high-end clients.
So what Paul was alluding to is that after our session here, we're all going to go into breakout rooms. You'll be able to speak one-on-one or hear a real detailed presentation on each one of these different types of investment strategies. You'll be able to learn more. That's what we're trying to do today. So make sure you listen, and if you have some questions, please feel free to raise your hands. Otherwise, we'll have the detailed talks in the back. Now I want to go back to Rob. Rob, we've got a lot of real estate operating companies, senior principals out there. We've got a lot of institutional equity sources out there. And we've got a lot of young people out there that are wondering what the hell, oh, excuse me. Well, it's not really radio. What the heck the real estate world is going to look like in 20 years when they're executing the meat of their career. What can you give them as an insight with the people, from the people that you meet with?
That's a tough one because, I mean, I never thought I'd be anywhere near finance. I was wanting to grow up to be an architect and designer and stuff like that, and somehow I'm, you know, in the middle of equity and finance every single day. I do have a passion for real estate. That's why I'm here. But I would say if you'd ask the majority of the people in the room, I doubt they had a pretty clear path. There's a lot more schools now today that have real estate programs that, you know, probably put you on that glide path a little easier. But I think what you have to expect is, to Trey's presentation earlier, which is phenomenal, by the way, wherever he's at, that the market's become more sophisticated. It's no longer the wild, wild west in the 80s. People kind of know what's being built and what's not being built. Technology enabled that. So you can see, you know, people are pulling permits. They see the supply coming. You know, foreign capital's in the market. It's transparent. Things like Bob White's RCA didn't even exist, you know, 15 years ago. I remember when it first came out. I was at Sperry or Collier's when it first came out, and just became big. And it's amazing the transparency and the window we see into small transactions all the way down to $2.5 million. So I would just say it's becoming a more sophisticated market. There's a ton of opportunities. There's probably more hats you can wear across the business in any given spectrum. I would say just go out and try to find as much experience as you possibly can. Don't focus so much on the paycheck, even though that's easier said than done. But I can promise you I worked for a few years for free. But in general, focus on the quality of the experience, the people you're with, whether it's development, whether it's finance, whether it's brokerage, all those roads lead to Rome. So get on whatever road it is, and then just keep your eye on the prize. And I think you're actually better off if you make a concerted effort to, they used to have a wheel program at CBRE that allowed you to experience each product type and brokerage sales. I don't know if they still have that. We created our own at Sperry back in the day. But go out and learn every product type as much as you can, you know, and hopefully you'll end up where you want to be, or you'll figure out it's a really tough business and go to something more promising like healthcare.
Now, Nathan, you alluded to it a little earlier. Sorry, I didn't give you enough time for that joke to really go over. That's my fault. I usually have better timing than that. I owe you a joke. I owe you a joke. Now, Nathan, the fact that you went to Bama, we won't hold that against you. However, you know, you talked about the fact that Inland specifically went to the Hill, and I know that your principals were at the Hill this week lobbying as well. I saw some of their materials. So there were problems with the old tenancy in common. You looked at that. You came out with this new product. Tell us a little bit about that.
So when you look back at the tenancy in common structure, you had a maximum of 35 investors. You were responsible for the debt, and really the lenders hated this. For those of you in the room that are lenders, you remember this, where each individual investor had to get approved for the debt, and it just became a mess. You could only have one property, you could only have one tenant, and then on top of that, all 35 of you had to agree on everything. My wife is wonderful, but she and I can barely agree on half of the stuff that we do, much less everything. And I'll give you an example. We had a property here in Disney that was leased to Disney. And on a triple net single tenant, once you get below 10 years, you begin losing value until you get that lease renewed. And we kept saying to the gentleman, it's time to sell. And one guy kept saying, I'm not selling this product. I love the fact that it's leased to Disney. I love their credit. And I'm not going anywhere. And so he held the entire fund up. And about 22 months later, we continued to bring them opportunities and opportunities, and every price got lower and lower and lower. So finally, he realized what we were saying. Of course, he went to Auburn, so you can appreciate why he had such difficulty in understanding that.
That's the wrong orange and blue.
That's exactly right, yeah. So the fact of the matter is that we said we got to do something where we can change, where we have a little bit more autonomy, where we can take the debt burden off of the investors, but really more importantly, get the size of the investment down. So the minimum is $25,000. You do have to be an accredited investor, but the minimums now are $25,000. They used to be $300,000 to $400,000. And more importantly, you can get diversification. So we've got them across the board. We usually have between 4 and 6 different offerings available, and they can be anywhere from single tenant with no debt up to 12 to 15 properties, where we just bought 20 properties directly from Walgreens. We just bought 26 properties directly from Family Dollar. So we're getting them before they've ever hit the street, once they're newly built, and then we syndicate them as a portfolio so that that investor who's got $100,000 to $150,000 doesn't want to pay the taxes can now go get diversification from that. And so we really felt passionate about that, as well as giving people, it was talked about earlier, the amount of transactions going on today. The fact is that people are wanting to unleash themselves from the day-to-day responsibility of having to manage that. And we provide them the opportunity to defer the taxes, get the income, but yet get diversification and really enjoy the fruits of the labor that they've done over the years.
Now, Kendall, about a year ago, I was moderating a panel on alternative investments. It was down in Miami Beach, and the gentleman that was speaking about crowdfunding pulled his little rollerboard up. He had Bermuda shorts, a yellow shirt, and not really shaven, but it wasn't Curacao, it was Miami Beach. And when he was done, he said anybody could come over to his apartment, he'd show him how to do it. Now, I think that things have changed a little bit since then. Can you talk to us about how the industry is evolving and becoming more professional? And I actually think that Robert indicated a little bit by how they're doing their institutional portal, and that's just coming online. So it sounds to me like you got a good idea.
Yeah, well, when this all started, it was a website, a couple of them called Kickstarter and Indiegogo, where people could go on and fund things like this watch, or you could go on there and say, I need a breast enhancement surgery. I want to raise $2,000. I mean, it went all over the board. People were trying to fund anything. But I was always interested in the part about starting businesses and doing things that would help people grow assets. And so this law that was passed in 2012 called the Jobs Act, jobs, by the way, one of the greatest congressional scams of all time. You guys will love this.
There are no such things as congressional scams.
This law was actually called the Crowdfund Act and got no traction whatsoever until a very, very bright congressional staffer said, why don't we figure out an acronym for jobs and call it the Jobs Act? Then everyone will want to pass it because nobody's against jobs. And so literally it's the Jumpstart Our Business Startups Act. Really doesn't have anything to do with jobs, but it flew through with 90% of both houses, the House and the Senate. Obama signed it 5 minutes later. It was just flew through. There was no opposition to it because who's against creating jobs and helping small businesses? Yet,
I'm sorry, I said without reading it.
Exactly. Well, it was about jobs. April 2012. We are now in February of 2015. And the main crowdfunding part of the act, the one that will allow the general public to invest in real estate, invest in new businesses, invest in inventions, invest in things, still is not allowed to be used because the SEC has not passed any final rules to allow it to happen. Parts of the Jobs Act that allow accredited investors to invest in these types of things exist, and this is probably the big difference, was that all really started about a year and a half ago when the SEC Title II of the 4 parts of the Jobs Act basically said we're going to lift the ban that's been around for 80 years on general solicitation. What does that mean? You can advertise the sale of these securities now. You can put it on the side of a bus. You can have a television commercial, and you can put it on a crowdfunding portal where people can come online, see the investment opportunity, and invest in it. Right now, you can only do that with accredited investors, but you're going to be able to do that with the general public whenever the SEC comes around. So your guy, Jim, that showed up was typical. I just wrote an article in Entrepreneur Magazine about the hucksters that have appeared who are crowdfunding experts or crowdfunding consultants, and they pay me $1,500, $2,500, I'll teach you how to do this. There is an art to doing this, but it's really just learning how to do marketing correctly and how to spread the word correctly. But when it comes down to raising money for real estate, when it comes down to raising money for new businesses, you're selling securities. You're not just online on Kickstarter getting money for a watch from people that just want to get a product later. You're selling securities. If you do it wrong, you go to jail. That guy that showed up there, that's, you know, us lawyers that have to make sure the security stuff is done right. It's going to be a nice thing for us to be able to do, but the problem is when these laws came out, these proposed rules came out from the SEC, this is a 9-page law. It's a simple law. Anybody in this room could read it and go, wow, you can go online, you can raise money for your business up to $1 million under this part from the general public, and it's not difficult. You just look at a Kickstarter type website and picture that where you can go in and buy stock from somebody. It's really a simple law. The SEC came out with 585 pages of proposed regulations for a 9-page law. And that's the problem. It's been 3 years of public comments and hearings and waiting for them to actually pare this down to how are you actually going to be able to do this. When that happens, it's going to be a very big game changer for the way businesses start and for smaller real estate projects, which, you know, is not exactly what these guys are doing, but it's going to be a really interesting thing for people to be able to go out and say, and just one last thing, everybody in the world, I mean, all of us here are relatively sophisticated in some aspect of the business world, but everybody, I mean, the 10 million people walking around at Space Mountain today, they understand what it means to invest in real estate. They get it. You know, they understand, I'd like to own a piece of property. I'd like to own a house. I'd like to own a piece of a hotel. I'd like to own something in the real estate world. They may not get investing in businesses or convertible debt and all these other things that go on. Everybody understands, I invest in real estate. I want a place at the beach. It's going to they think they get it. So the general public is going to love getting involved in these projects when they're allowed to do it. There's going to be some questions about how to do it, how to educate them, how to do things the right way, but it's going to be a really big boon for the real estate market when you can go out to the general public and say, you know, for $1,000 you can own a piece of this hotel we're building out here on the beach. And that's going to happen very soon.
Yeah, a lot of the people I know are creating syndications that are about I own it real estate, people like Thor Equities, and that's you know, it's the old syndication model. Now, a couple of years ago, I didn't really understand what the family offices were. Then I realized that I could start introducing myself as Jim Freed, Director of Investments for Mayan Properties, also known as the Katz Family Office, and my ability to solicit changed dramatically and also to find operating partners. Tom, a lot of the people that you work with got burned in the last cycle on a lot of fund investing, hedge funds and stuff like that. Now it seems like they're looking to direct invest and looking at channels like that. How are you seeing the way your clients are looking at the real estate market?
Well, Jim, that certainly is the reason that I'm here, and I've been invited to 2 more real estate conferences next year, and I haven't been invited to a real estate conference in about a decade, all for the same reason. First, there are 4 major real estate firms and 4 families that are not here today. And the reason they're not here is because they all went under between 2008 and 2010. And at the low end, 3 of these families were among the top 10 home builders in the United States, all companies that I'm sure you would know, ranging from $125 million net worth to about $275. All 3 were personally bankrupt by the end of 2009. And we represented 2 of the largest real estate families in each of 2 states. One survived, but barely, and the other went from $700 million to personally bankrupt in the scope of 18 months. So after experiencing that, you get a sense for the appetite family offices had for real estate. It turned off almost completely, and then once things hit the bottom, families who were in cash started getting back in fast and furiously. And in 2014, the predictions at the beginning of the year were that family offices' primary investment in 2014 would be real estate. And we're about to issue what we call a family office outlook. We do this every year, and the 2015 one's about to come out. And it is one of the predictions that it'll continue to be the dominant investment for family offices this year. So this side of the market, is somewhere between retail, crowdfunding, and institutional. It looks a lot more like institutional. These are pretty sophisticated families. They understand what they're looking for, and so think of them as institutions. They tend to have very long-term staying power, so they're a good long-term partner in these deals. But to Jim's point, the clamor for direct investing, which is also one of the most significant trends in the family office industry, is that they are trying to come in pari passu with the family running the deal, without upfront fees, very nominal syndication costs and legal fees, no upfront general partner manager fees, and be in the deal with the family. And I literally heard a quote: the operating family asked the investing family, how long would you like to be in this deal? And the response was, how long would you like to be in this deal?
Wow, I'm speechless. That's a pretty powerful statement. And remember, we're going to have breakout sessions with all these people afterwards. You're going to be able to really drill down deep, because I know we're really going by a lot of this stuff real fast. I'm going to go back now to Rob. Rob, you mentioned to me as a capital markets guy what I consider to be the unicorn, programmatic investing. Now, every time I go and I call an institutional client, they say, yeah, programmatic investing, that's if the first one goes good, we'll do the next one too if you give us the shot. Is there really a true ability to generate programmatic investment through your firm for real estate operating companies?
Well, Matt, yeah, absolutely is the answer. We just done a couple $100 million programmatic JVs this past year. But let me caveat that by saying what programmatic investing is not today, which it was before '08 in some cases, is it's not a bucket of money in your closet that you get to go and pull out to do whatever kind of deal you want once a capital provider feels like you have a great strategy. That doesn't happen. It's basically like a bunch of little mini JVs with your pipeline of deals. Those are usually crossed, and those usually have kind of an outline or a sandbox you play in that says, if I'm a medical office building developer, you're going to buy medical office buildings in these markets. The characteristics are going to typically look like this. These are the attributes. These are the size. These are the tenants. This is how we pursue it. This is how we close it. This is when we get entitlements. This is when we get a CO. I mean, it's very defined. And then we go out, and depending on your strategy and your return, whether it's an opportunity fund, a closed-end, open-end, life insurance company, pension fund, family office, it really all depends on the strategy, the market, et cetera. But we think of ourselves as snipers in the business, if you will. We're a very small shop. We're not an HFF or a big shop. We are equity guys 100%. We go find the right capital. We turn down way more business than we take in. We only work on 5 to 7 deals a year. We're going to change that with the platform, with the crowdfunding platform, really kind of in the exact format that Tom was just talking about, which is really not, the grandmother who sends in $100. I mean, I think that's ripe for fraud, that model. I mean, real estate's an illiquid asset. We need to make sure there are high net worth people who are coming to the table and understand the strategy and can afford not to take their money back for 5 years. But programmatic, absolutely. We do it all the time. We've done a lot of it, and it is very hard. I'd be lying to you if I said it was easy. The average engagement takes 6 to 8 months to get it done. The fastest we've done it's probably 3 months. But it really is tough. And there's a ton of capital out there, as the slides showed earlier, but it's still really hard to get capital to invest in strategy. And then there's a bunch of deviations of that. There's platform, there's entity level, there's just a club fund format. And it's not always the right thing for some people. So anyway, just like discretionary funds, everybody wants a discretionary fund. It's really not what you want in this market, because it could take you 16 to average. If you're a well-known fund with multiple funds in your history that has a great track record, it's the average time frame to raise a discretionary fund. If it's a real fund, 100 million plus, it's 19 months. Who wants to wait 19 months to go execute your pipeline? So we look at it, the way we look at it is we spend a lot of time up front with the strategy, building, validating track record IR, understanding your strategy and your marketplace and your product type, and then we match up the right investor, and then we try to seed the partnership with a deal or two that becomes very programmatic after that. But it's not a bucket of capital you go use as you wish.
Now, Nathan, you were talking about, you used the dirty word syndication earlier. You were talking about how people can come and they can invest in a piece of this deal or a piece of that deal, and Inland just bought a bunch of single-tenant deals, and they can negotiate the lease because they have that kind of buying power. They can negotiate a good loan because they have that kind of buying power. Give us an example of what one of your, I get the list every week. Give an example, because some of that stuff that's been coming out, it's really been evolving, even in just a short time I've been on your platform.
Yeah, so obviously, as we saw before, cap rates have come down. But what's interesting is so have the debt costs. So if we go back to, let's say, 2010, 2011, debt costs were more like 5%. So cap rates may have been, we'll call it 8.5, but the debt costs were 5. So you had a 350 basis point spread between cap rate and financing. Today, we're seeing cap rates anywhere from 6.25 to 7.25, but financing costs are anywhere from 3.25 to 3.95 is what we did on our last deal. And these are fixed rate because obviously you don't want to be in a variable. So what we'll do is we will underwrite the assumptions of vacancies and debt repayment and tenant improvements and CAM. So it could be anywhere from starting off at a 5 to 6% net cash flow to the investor. And again, in a 1031 exchange, you get to take all the benefits that you do from direct investing. So therefore, your tax advantage could be anywhere from 50 to 100% of the income to be tax deferred or tax free as long as you stay in a 1031. So you get all the benefits. And again, we're going to start off, we tend to be ultra conservative, assume vacancies. The last deal that we just put out is a group of Colorado apartment deals, for example. It's a $90 million equity raise, $183 million total deal. So we're at about 51% loan to value. Traditionally, we tend to stay in the 40 to 60% range, starting off at a 5% cash flow. And we're only underwriting, occupancy at 87, 88, and 90% on those, yet we're already at 93, 95, and 95% occupancy. So again, our cash flow predication is on lower occupancy than already is because we told the developers when we put it out, we wouldn't even buy it from them until they hit 90%. So our whole thing is predicated on consistency of ability to pay the distribution rate that we forecasted, protection of your client's principal, and then most importantly, return of that principal, obviously, hopefully with some growth. But we try and have, I call it, we'll call it a menu approach. No matter what in today's world, you have the cash investor that says, I do not want debt. I don't care if you tell me that it's non-recourse to me. I don't care if you tell me it adds to my cost basis. I don't want debt. So we try and have one of those a quarter. We actually have been doing less and less because the value of real estate's come back, but we were doing deals for where people were upside down. So we were doing 83% loan to value, where it was pure payback of the loan and build up of principal along the way. So you could go from 83% debt to equity down to 58%, therefore actualizing an 11 to 12% rate of return or IRR per year with your capital back and deleveraging the entire way. But our sweet spot is really 40 to 60% in debt, because most investors who come to us simply want to take the maintenance of the property off of their hands. They want to get diversification and they want to get cash flow. So our sweet spot is kind of the 40 to 60% loan to value field, Jim, with cash flow and appreciation on the backside. Yeah,
that sounded like to me you went real fast by the part where the guy sold a really ratty shopping center and instead translated that into Class A investment quality stuff.
Yeah, and I was just going to comment on that. I mean, and I would say we've looked at a lot of platforms to underwrite as a broker-dealer because our goal is to provide as many kind of investment options as possible to the end user. And there's a reason Inland's the only REIT on our platform, or REIT company, because the way they underwrite, I mean, there's a couple other big groups that are doing DSTs, and I'm not just doing this for a shameless plug because they got plenty of broker-dealers out there selling their stuff. But I would tell you what's sexy about it, and maybe it's not sexy, it shows you how much I get out, but I don't think you refer to DST as sexy.
Calm down now.
Yeah, but anyway, what's great about it is if you're a broker-dealer or a developer, you can use it as a planning tool for how your clients or yourself, you go into a different deal. You don't have to sell a building, make $3 million and put it into a DST, into a Starbucks or whatever. You can do it across a portfolio. I mean, a lot of the work, and I'm not the guy in charge of the 1031 program, it's JL in our office, but...
Yeah, we invited him first,
Yeah. We don't let him speak in public. So, anyway, you can diversify those dollars across multiple product type different portfolios these guys have. These portfolios are amazing because they fill up so fast. You can have $90 million of a reverse. It's basically a reverse syndication. That's the way to think about it. You buy the deal, you close it, and you reverse syndicate it. And then you're passive, and you have a professional asset manager in place. But what's nice is you can, I mean, we have a couple brokers we've had to bring on in our office to just help our high net worth guys, because most of our referrals and our client base comes from guys like Tom's company or big CPAs, wealth managers. I mean, we raised a $75 million fund last year for Apartment Group, and that was through two people, aggregators, that we call them aggregators, but the guys like Tom that have a trusted relationship. But that was ultimately 600 individual accredited investors. So when guys like that come to us and they want to do estate planning, we're not estate planners, but when it comes to real estate, we can say, why don't we take a couple $1,000,000 or a couple $100,000 and put into a DST? And then why don't we, you're still kind of a control freak like most of us real estate guys are, why don't we find you a shopping center? We're doing 2 right now in Orlando. Why don't we show you a shopping center that's triple net leases, 10 plus years on the lease left in place, and just good old-fashioned triple net real estate deal. So it's not just security or not security. You can use it as a diversification tool.
Okay, this is the part I love about my radio show. We've only got 5 minutes left, guys. So I'm going to ask Kendall. Kendall, my aha moment on crowdfunding was when a group that met me at the same family office event that I met Tom at for the second time came up to me. They flew down from Boston. They wanted us to invest as a family in their real estate deal. We said, that's probably not for us. He says, well, you better let me know fast because I'm going to Brickell and I'm going to raise the money on Brickell. Well, that's where all the foreign investors are and all the banks are. I said, okay, no problem. 3 days later, I got an early shares teaser from them. Early shares is not just real estate. They do other things too. But I met with them after that happened, and that's what caused me to understand that this is a tsunami that's coming. And then I got one more question for Tom after this.
Sure. Well, I'm going to take all 5 minutes.
I figured you would.
First of all, before I end here, I just want to point out that my breakout session, because I'm the only University of Florida graduate on the panel, has an open bar. So, well, at least they told me that. They told me that.
No, it's 100% true.
Blame the people out there if it's not there. I'm not paying for it. So.
Not really.
No, it is a flood, and one of the reasons, I think Robert made a very good point, institutionally raising money is very hard, especially when you're dealing with accredited investors. I do it all the time for companies. I do a lot of private equity work in my law practice. It's very difficult. I mean, when you're trying to get, wealthy people get barraged with opportunities, and they have to pick and choose, and getting them to stroke a check, I usually drop the mic when I leave the stage, but getting them to stroke the check, the big check, is not always easy. And 19 months to raise $100 million, it's a long time. You know, the beauty of this flood that's coming, and I'll talk in the breakout session a lot about the fraud and the potential problems, but the beauty of this is crowdfunding campaigns take 30 to 60 days. You're done. You either raise the money or you don't. It's not going to drag out for 19 months. You know, if you're not raising the money in the first 30 to 60 days, you're doing it wrong, and you're not going to ever raise the money. So it's, you get in, you get your money, or you don't. But you know this is how it's going to work. It's a short time frame to raise the money, and that's why people get so excited about it. Is it's not the traditional way of doing things. It's all open. It's all on the internet. You can see a video. You can see all the documents. It's all there for people to look at. All the due diligence is right there online. You're not behind a closed door in a hidden room. Here's a little PPM. Sign this. Give it right back to me when it's done. None of that. It's right there for everybody to see. And one of the reasons that everyone keeps saying there's going to be all this fraud, there's going to be all this fraud, this is going on in 160 countries right now already. Okay? There has not been a single report of fraud in England, Australia, Europe, through crowdfunding to the general public. Not one yet. Yet, when we deal with accredited investors and the people that really know what they're doing, you get the Bernie Madoffs of the world. Okay? It's going to happen. There's fraud in everything. But the fact that it's so publicly open and available online for everybody to see anything, who's going to be stupid enough to put your face out there on the internet, all of your information, undergo SEC background checks, undergo all of the things you have to do to raise the money, and then steal money from people? You're going to go right to jail. They know right where to find you. So people worry about fraud a lot. I don't think it's going to be as bad as they say it's going to be.
Yeah, and one thing I want to emphasize is that in that breakout session, one of the things I hope you'll talk about, I spoke to a banker yesterday, is the viability and fungibility of the equity as far as a component in the capital stack. We don't have enough time to talk about that right now, but there are banks, they treat it just like equity, and I'd like you to talk about that in the breakout session. Tom, can you just tell us one of the stories? You told a great story at the Wilson event that I went to that talked about the difference between family members that knew to go into the office and family members that didn't know to go into the office and what the impact was. It's not a real estate story, but I think it sheds important light on the nuance that working with the family with the right information, the impact that can have.
Well, and it directly applies to real estate. So in my humble opinion, the real estate industry are the most flagrant violators of the SEC's broker-dealer rules on the planet. Our estimate as a law firm was that 40% of family offices have some non-compliant issue, 40%. Another major law firm that does a lot of work in this area, their estimate was 50, so we think it's bad. If I were to estimate the number of broker-dealers that are violating, real estate people violating the broker-dealer laws under even a narrow construction, I won't say it out loud because I don't want the SEC to come following all of you in the future, but I'm happy to give you my private estimate, and it's not a good one. So in a nutshell, two key things affect real estate. One is when you're seeking investments in family offices, one of the keys is it has to be structured not to blow the family office exemption if, in fact, the family is exempt from RIA and broker-dealer registration. That's a very critical issue. You're never going to get in. You're never going to get to square one if you violate those rules. The other piece of that is that if the family is operating in the venture and they have other projects where they can aggregate them together, if you have 500 hours as a general rule, and it's more nuanced than this, you have 500 hours in a project, you are active. And the active designation here means that you can avoid the Obamacare tax. So for both potential investors, this becomes highly relevant, and then for companies and the people actually active in real estate, it becomes relevant. A key element that almost no one knows or is aware of, if you own the real estate in your trust and you are the beneficiary and you have in 4,000 hours per year, you are not active in your real estate because the trustee is not active. So unless your trustee is doing the real estate, you're not active in that business and you're subject to the Obamacare tax. Now, the bar doesn't like this. We just submitted ABA submitted a huge paper to the IRS and to Congress. My partner was one of the chief architects of that paper. So we're suggesting the beneficiary should count for this active-passive rule. Right now it does not. So the solution is you need to be your own co-trustee. Become a co-trustee and make sure you don't have any rules in there that will throw the assets back into your estate. A huge Florida family, coincidentally, owns a major business, about a $7 billion business, and it's privately held. And none of their advisors, the in-house family office people, the CPAs, the lawyers, the two outside law firms, and the outside CPA firm, nobody advised them that the Obamacare tax was coming, even though we knew it was coming 2 years ahead of time. It had passed, and it was a prospective tax. So in October of last year, the family finds out that they're subject to this tax. And so they went to the children, and the children were advised that you're going to pay, and the lowest was $2.1 million, between $2.1 and $2.4 million per family member of just Obamacare tax. And so in October, with less than 3 months to go, they're told, oh, but if you had 500 hours in this, you would avoid that tax. So one of the family members said, so let me be clear. Had you told me about this when I should have known 2 years ago, I could have put in 500 hours, and yeah, I don't work much, but you think I wouldn't put in 500 hours to save over $2 million? You've got to be kidding me. So the firm then said, well, you can start right now and keep a log, and you can jam in that time and try to get it in between now and the end of the year. And they gave him misadvice. They said, you can't count your time from earlier in the year, and that's wrong. A contemporaneous log is the most relevant evidence, but you can do the log after the fact. You can track your computer time. You can track the time on the security transponder that goes in and out of the office building. So we advise them to go back, pick up all the earlier time in the year, and then keep a calendar and Outlook backup for all the time going forward and hit the $500 number because the consequence was absolutely gargantuan. But that active-passive issue is highly relevant for real estate, particularly if they have other ventures besides yours. So keep it in mind when you're seeking investors or you're co-venturing with family office investors.
All right, we're going to break. Make sure you go and find the thought leader that you want to hear from. I brought you the 4 top thought leaders that I know in these categories. These are people that are shaping the future of real estate. Come meet them in person now. Thank you, everybody.